The book I'm trying to talk about, The Intelligent Investor, it's no fad trying to give you easy motivation on how easy it is to make money. It talks about investing strategy, the risks that are involved when investing, and how you can minimize these risks to maximize your gains. And well, if that doesn't sell you on it, the book is even written by one of the greatest investment teachers of all time, Benjamin Graham, having even taught his strategy to the likes of Warran Buffet. And even though this book is focused on stocks and bonds, it has other great takeaways that you can take into other areas of investment, such as real estate. So anyone who is trying to invest their money, I can't emphasize this enough, you must give this book a read before investing. Because I can almost guarantee you it will completely change the way you think of investing and have you thinking like the pros. So in today's video, I'll be telling you about what I thought were the 3 most important takeaways from The Intelligent Investor and how you can start to apply these rules into your investing journey right now. Now, probably the most talked about idea in this book is a speculative buyer versus an intelligent investor. Now, the question is, which one are you? Well, according to Benjamin Graham, there are 3 things you must do in order to be considered an intelligent investor and not a speculative buyer. First, there should be a thorough analysis of the company and its underlying business. Secondly, you should deliberately protect yourself from any serious losses. And lastly, you should inspire for adequate performances, not extraordinary performances. Now basically, when buying a stock, if you can't tick off Benjamin's 3 requirements for buying a stock, you probably shouldn't be buying the stock in the first place because it's probably a speculative buy. Now let's talk about some speculative purchases, such as when Elon Musk started getting quite famous online, Tesla's share price started to soar through the roof, getting to a PE ratio of 1396. Now this meant at this point, Tesla's shares costed 1396 more times the profit on a per share basis, which is ridiculously high. Now let's go back to Graham's 3 rules. Is the stock safe? Well, definitely not at a PE ratio of 1396. Have we done a thorough analysis of Tesla's company? No, we haven't yet. And lastly, are we inspiring for adequate performances, or are we hoping Elon Musk can produce us extraordinary performances? Now Benjamin Graham even goes as far as saying if you've applied his 3 rules, you should feel safe investing in stock without even knowing its stock price. Now the question is, can you still make speculative purchases? Well, Benjamin Graham actually still talks about this in The Intelligent Investor and suggests never to put more than 10% of your portfolio in speculative purchases. And this is because speculative purchases is just like gambling, and just like gambling where the house always wins, the market always wins. This is because if you're trying to find the next Microsoft or Facebook, what are the chances you're going to find this winner out of thousands and thousands of stocks? Well, the answer is very slim. So just like the person trying to earn their financial freedom in a casino, the chances it's actually going to happen is very slim. Now, the second most important takeaway I took from The Intelligent Investor was becoming emotionless. Now, I don't mean having no emotion in life when it comes to hanging out with family and friends, but being emotionless when it comes to your investing strategy and buying stocks. Now, a common theme mentioned in this book is Mr. Market. Now, of course, Mr. Market is not a real person, but is more of a metaphor. Now, Mr. Market is the person showing you all the little price movements in a stock, whether it's going up or down, and trying to influence you whether you should be buying or selling a stock. Now, unfortunately, when you end up listening to Mr. Market, you often end up buying a stock when it's at the peak, and then selling a stock when it's around the bottom. Basically, when a stock is going up, Mr. Market is very greedy and optimistic about a stock's future, encouraging you to purchase it. And when a stock is going down, Mr. Market is very fearful and doubtful of a stock's future, encouraging you to sell it. Now, in Benjamin Graham's book, The Intelligent Investor, he tries to encourage us to ignore Mr. Market, as the small price movements in a stock price is not important in the long term. Now, what does Benjamin Graham tell us to do then? He tells us to do a fundamental analysis of the company and its underlying business for starters, and ignore any other information that is not important, such as the small price changes that happen every day, or people on social media talking about a certain stock. Now, we might be thinking we don't make decisions based on emotion. Well, if you've invested in Coca-Cola, maybe because it's been around for centuries or because you drink the Coca-Cola, this is probably an emotional decision and is a familiarity threat. Or maybe Elon Musk says he's selling the stock in a company, and out of fear you make an emotional decision to sell too, without any fundamental analysis of why. So it's so important we don't let our emotions control us when making decisions, but base our decisions off fundamental analysis alone. Now, a third point The Intelligent Investor has a big focus on is inflation. Now, of course, early on in my investment journey, I never really took inflation into consideration and how it could affect my investment returns, but you should, because inflation can have a massive effect on your investment portfolio and how much returns you actually end up making. Now, just to give a quick recap of what inflation is, it basically shows the rate of increases in prices over a period of time. Now, just to show how poorly inflation has been taken into consideration in the past, in the 1980s, people were happy to be getting 11% return on term deposits, whereas they were really disappointed to be only getting a 2% return on term deposits in the early 2000s. Now you might be thinking, wait Josh, isn't an 11% return much better than a 2% return? However, one thing both these investors forgot to take into consideration was inflation. Now in the 1980s, inflation was actually over 11%, meaning your term deposit earning an 11% return was actually losing money. However, in the early 2000s, inflation was only around 1%, so with a term deposit return of 2%, you're actually making a 1% return on your money. Now, as weird as this might be to comprehend, your money was actually making a faster rate of return at a 2% term deposit than at an 11% deposit, just because of inflation. Therefore, the things that really stood out for me in The Intelligent Investor was being an intelligent investor and not a speculative buyer, buying stocks based on zero emotion, and also taking into consideration inflation on your investment returns. Now honestly, if you're planning on investing in the stock market, I highly recommend you buy this book, The Intelligent Investor from Benjamin Graham, as it is a great read and will teach you almost everything you need to know before investing in the stock market. Anyway, thanks for watching. If you could like and subscribe, that would be greatly appreciated. And if you've read the book, The Intelligent Investor from Benjamin Graham, chuck a comment below what you thought about it. Till next time, see you later.